The sweeping changes of financial deregulation in Australia during the 1980s have left indelible marks on the nation's economic landscape, resonating through to the present day. Understanding the complexities and consequences of those defining years offers invaluable lessons for economic history enthusiasts and students alike. It is essential to grapple with this question because the course of financial deregulation has significantly shaped modern Australia's economic policies and global positioning. In the early 1980s, Australia embarked on a journey of financial deregulation under the governance of Prime Minister Bob Hawke and Treasurer Paul Keating. The motivations were clear: to modernize the economy, boost competitiveness, and address inefficiencies plaguing the financial sector. The initial steps included floating the Australian dollar, removing exchange rate controls, and allowing foreign banks to operate within the country. Critics and proponents alike agree that these reforms unleashed unprecedented economic dynamism. On one hand, deregulation fostered a surge in foreign investment, stimulated economic growth, and improved financial efficiency. Australian enterprises faced fewer barriers in securing capital, and the competitive landscape became vibrant and diversified. This period also marked Australia's transition towards greater economic integration with the global market. However, these structural changes were not without repercussions. Critics argue that deregulation contributed to financial volatility, inequities, and systemic risks. The late 1980s and early 1990s saw economic pressures boil over into the recession we had to have, as termed by Keating himself. Some observers argue that the banking sector's speculative excesses and an overheated economy led to this downturn. Furthermore, financial deregulation has been linked to widening income inequality, as gains were often disproportionately accumulated by wealthier segments of society. In the ensuing decades, Australia's financial landscape continued to evolve. The regulatory framework had to adapt, reflecting lessons learned from both domestic and international crises, such as the global financial crisis of 2008. Australia's strong regulatory response to the crisis has been applauded, reinforcing the view that some level of oversight remains essential to maintaining financial stability. Examining these dynamics reveals the multifaceted implications of financial deregulation. It underscores the importance of striking a balance between market freedom and regulatory oversight. The legacy of the 1980s reforms is neither wholly positive nor wholly negative. It is a testament to the complexities inherent in economic policymaking. As policymakers continue to navigate the interplay between regulation and deregulation, the historical experience of Australia offers crucial insights. Understanding this legacy serves not merely as an academic exercise, but as a practical guide for shaping future economic policies. The questions it raises about risk, stability, and equity remain deeply relevant, signposting the way for navigating the economic challenges of tomorrow.